Welcome. Today, we're diving into the world of mutual funds and exploring their vital role in investment portfolios. Whether you're a seasoned investor or just starting out, understanding mutual funds can help you make smarter financial decisions. Mutual funds pool money from many investors to invest in a diversified portfolio of stocks, bonds, or other securities. This approach offers professional management and diversification, making them a popular choice for individuals looking to grow their wealth while managing risk. Let's begin by understanding what mutual funds are and why they matter in your investment journey. Mutual fund is an investment vehicle that collects money from multiple investors and invests it in a variety of assets, such as stocks, bonds, or other securities. This pooling of resources allows individual investors to access a broader range of investments than they might be able to on their own. The fund is managed by professional fund managers who make decisions on buying and selling assets, aiming to achieve the fund's investment objective. Mutual funds are structured to provide diversification, which helps reduce the risk associated with investing in single securities. You invest in a mutual fund, you're essentially buying shares of the fund. The value of your investment rises or falls based on the performance of the underlying assets. Fund managers use the pooled money to buy a mix of securities according to the fund's strategy. As the assets generate returns through dividends, interest, or capital gains, these are distributed to investors or reinvested. This structure makes mutual funds accessible and flexible, allowing investors to participate in markets without needing to pick individual stocks or bonds themselves. Mutual funds come in many varieties, each designed to meet different investment goals. The main types include equity funds, which invest primarily in stocks, bond funds, which focus on fixed income securities, balanced funds, which combine stocks and bonds, and money market funds, which invest in short-term debt instruments. Each type has its own risk and return profile, allowing investors to choose funds that align with their financial objectives and risk tolerance. Understanding these categories is key to building a well-rounded investment portfolio. One of the biggest advantages of mutual funds is diversification. By pooling money from many investors, mutual funds can invest in a wide range of assets across different sectors, industries, and geographies. This diversification helps reduce the impact of any single investment's poor performance on the overall portfolio. For individual investors, achieving such broad diversification on their own would be challenging and costly. Mutual funds make it easy and cost-effective to spread risk and pursue more stable returns. Mutual funds are managed by experienced professionals who analyze markets, select investments, and monitor performance. These fund managers use their expertise to make informed decisions, aiming to maximize returns while managing risk. For investors who lack the time, knowledge, or resources to research individual securities, mutual funds offer a convenient way to benefit from professional management. This expertise can be especially valuable during volatile market conditions, helping investors stay on track with their financial goals. Another key benefit of mutual funds is liquidity. Most mutual funds allow investors to buy or sell shares on any business day at the fund's net asset value (NAV). This means you can access your money relatively quickly compared to some other investments, like real estate or certain retirement accounts. Mutual funds are also accessible, with low minimum investment requirements and the ability to invest through various platforms. This makes them suitable for both beginners and experienced investors alike. While mutual funds offer many benefits, it's important to understand their cost structure. Common fees include management fees, which pay for the fund manager's services, and operating expenses, which cover administrative costs. Some funds also charge sales loads or commissions when you buy or sell shares. These costs can impact your overall returns, so it's crucial to review a fund's expense ratio and fee schedule before investing. Comparing costs across different funds can help you make more informed choices. Like all investments, mutual funds carry risks. The value of your investment can fluctuate based on the performance of the underlying assets. Equity funds are subject to stock market volatility, while bond funds face interest rate and credit risks. Even money market funds, though generally safer, are not entirely risk-free. It's important to assess your own risk tolerance and choose funds that match your comfort level and investment goal. Diversification within mutual funds helps manage risk, but it doesn't eliminate it entirely. Mutual funds can be actively or passively managed. Active funds rely on fund managers to select investments and try to outperform the market. Passive funds, such as index funds, aim to replicate the performance of a specific market index by holding the same securities. Each approach has its pros and cons. Active funds offer the potential for higher returns but often come with higher fees. Passive funds typically have lower costs and can be a good choice for long-term, hands-off investors. Index funds are a type of passive mutual fund that aims to mirror the performance of a specific market index, such as the S&P 500. Instead of trying to beat the market, index funds simply track it by holding all or a representative sample of the securities in the index. This approach results in lower management fees and operating costs. Index funds are popular among investors seeking broad market exposure, low costs, and a straightforward investment strategy. Growth funds are mutual funds that focus on companies expected to grow faster than the overall market. These funds typically invest in stocks of companies with strong earnings potential, innovative products, or expanding markets. While growth funds can offer higher returns, they also come with higher volatility and risk. They're best suited for investors with a higher risk tolerance and a long-term investment horizon, looking to maximize capital appreciation. Income funds are designed to provide regular income to investors, typically by investing in bonds, dividend-paying stocks, or other income-generating assets. These funds are popular among retirees or those seeking a steady cash flow from their investments. While income funds tend to be less volatile than growth funds, they still carry risks such as interest rate changes or credit risk. They can be a valuable component of a balanced portfolio, especially for those prioritizing income over capital gains. Balanced funds, also known as hybrid funds, invest in a mix of stocks and bonds to provide both growth and income. This combination helps balance risk and return, making balanced funds a popular choice for investors seeking moderate growth with some income stability. The allocation between stocks and bonds can vary, so it's important to review each fund's strategy. Balanced funds are ideal for those who want a diversified portfolio in a single investment product. Money market funds invest in short-term, high-quality debt instruments like treasury bills and commercial paper. They aim to provide safety and liquidity, making them a popular choice for conservative investors or those needing quick access to their money. While money market funds offer lower returns compared to other mutual funds, they are considered one of the safest options. They're often used as a place to park cash temporarily or as part of an emergency fund. International mutual funds invest in companies outside the investor's home country. These funds offer exposure to global markets and can help diversify a portfolio beyond domestic investments. International funds can capture growth opportunities in emerging markets or developed economies abroad. However, they also come with unique risks, such as currency fluctuations and geopolitical instability. Including international funds in your portfolio can enhance diversification and potential returns, but it's important to understand the additional risks involved. Sector funds focus on specific industries or sectors, such as technology, healthcare, or energy. These funds allow investors to target areas of the economy they believe will outperform. While sector funds can offer high returns if the chosen sector does well, they also carry higher risk due to their lack of diversification. Sector funds are best suited for investors with strong convictions about a particular industry and a higher risk tolerance. Target date funds are designed for investors planning to retire or reach a financial goal by a specific year. These funds automatically adjust their asset allocation over time, becoming more conservative as the target date approaches. Target date funds offer a hands-off investment solution, making them popular in retirement accounts. However, it's important to review the fund's glide path and ensure it aligns with your risk tolerance and retirement timeline. Tax efficiency is an important consideration when investing in mutual funds. Some funds are managed to minimize taxable distributions, making them more suitable for taxable accounts. Index funds and tax-managed funds often have lower turnover and fewer capital gains distributions. Understanding the tax implications of your mutual fund investments can help you keep more of your returns and optimize your overall portfolio performance. Many mutual funds offer automatic investment plans, allowing you to contribute a set amount on a regular schedule. This approach, known as dollar-cost averaging, helps smooth out market fluctuations and encourages disciplined investing. Automatic investing makes it easier to build wealth over time, as you consistently add to your portfolio regardless of market conditions. It's a convenient way to stay committed to your financial goals. Mutual funds often give investors the option to reinvest dividends and capital gains automatically. Reinvesting earnings allows your investment to compound over time, accelerating growth. This feature is especially powerful for long-term investors, as it helps maximize returns without requiring additional contributions. By letting your money work for you, reinvestment can be a key driver of wealth accumulation in your portfolio. Mutual funds are subject to strict regulations and must provide regular disclosures, including performance reports, holdings, and fees. This transparency helps investors make informed decisions and compare funds easily. Regulatory oversight also protects investors by ensuring that funds operate fairly and in accordance with the law. When you invest in mutual funds, you benefit from a level of transparency and accountability that's not always present in other investment vehicles. Mutual funds play a significant role in retirement planning. They're commonly offered in retirement accounts like 401(k)s and IRAs, providing a range of investment options to suit different risk profiles and time horizons. The ability to diversify, access professional management, and automate investments makes mutual funds a cornerstone of many retirement strategies. By including mutual funds in your retirement plan, you can work toward long-term financial security and growth. Mutual funds are often used as the foundation of an investment portfolio. Core holdings typically include broad-based equity or balanced funds, providing stability and growth potential. By starting with a solid core of mutual funds, investors can then add specialized funds or individual securities to tailor their portfolios to specific goals or market views. This approach helps ensure a strong, diversified base for long-term investing. Beyond core holdings, investors may use specialty mutual funds to target specific strategies or market segments. These can include sector funds, international funds, or funds focused on small-cap stocks. Specialty funds add flexibility and the potential for higher returns, but they also introduce more risk. It's important to balance specialty funds with core holdings to maintain a diversified and resilient portfolio. Exchange-traded funds, ETFs, are similar to mutual funds but trade on stock exchanges like individual stocks. While both offer diversification and professional management, ETFs typically have lower expense ratios and greater trading flexibility. Mutual funds, on the other hand, are often better suited for automatic investing and retirement accounts. Understanding the differences can help you choose the right investment vehicle for your needs. In selecting mutual funds, it's important to evaluate their historical performance, but remember that past results don't guarantee future returns. Look at long-term performance across different market cycles, compare to relevant benchmarks, and consider consistency. Also, review the fund manager's track record and the fund's risk-adjusted returns. This comprehensive approach helps you identify funds that are more likely to meet your investment objective. Mutual funds prospectus is a key document that outlines its investment objectives, strategies, risks, fees, and past performance. Reading the prospectus helps you understand what you're investing in and whether the fund aligns with your goals. Don't skip this step, it's essential for making informed investment decisions and avoiding surprises down the road. Once you've invested in mutual funds, it's important to monitor your holdings regularly. Track performance, review fund reports, and stay informed about any changes in strategy or management. Periodic reviews help ensure your investments remain aligned with your goals and risk tolerance. Adjust your portfolio as needed to stay on track for long-term success. Over time, the value of different investments in your portfolio may shift, causing your asset allocation to drift from your original plan. Rebalancing involves buying or selling assets to restore your desired allocation. Mutual funds make rebalancing easier, as you can adjust your holdings within a single account. Regular rebalancing helps manage risk and keeps your portfolio aligned with your investment strategy. Dollar cost averaging is a strategy where you invest a fixed amount in a mutual fund at regular intervals, regardless of market conditions. This approach reduces the impact of market volatility and can lower your average cost per share over time. Dollar cost averaging encourages consistent investing and helps take the emotion out of investment decisions, making it a valuable tool for building wealth gradually. Systematic withdrawal plans allow investors to receive regular payments from their mutual fund investments. This feature is especially useful for retirees who need a steady income stream. You can set up withdrawals monthly, quarterly, or annually, tailoring the plan to your needs. Systematic withdrawals help manage cash flow and provide flexibility in retirement planning. Mutual funds are an excellent starting point for new investors. They offer diversification, professional management, and easy access to a range of assets. Beginners can start with low minimum investments and gradually build their portfolios. Educational resources and support from fund companies make it easier to learn about investing and develop good financial habits from the start. Experienced investors can use mutual funds to implement advanced strategies, such as sector rotation, international diversification, or alternative asset exposure. Mutual funds offer access to specialized markets and professional insights, complementing individual stock or bond holdings. By combining mutual funds with other investments, experienced investors can fine-tune their portfolios and pursue specific financial objectives. Socially responsible mutual funds, also known as ESG funds, invest in companies that meet certain environmental, social, and governance criteria. These funds allow investors to align their investments with their values, supporting companies with positive social or environmental impacts. Socially responsible funds are growing in popularity as more investors seek to make a difference while pursuing financial return. While diversification is a key benefit of mutual funds, it's possible to over-diversify by holding too many funds with overlapping investments. Over-diversification can dilute returns and make it harder to manage your portfolio effectively. It's important to review your holdings regularly and ensure each fund adds unique value to your investment strategy. Quality, not quantity, should guide your diversification decision. Fund turnover refers to how frequently a mutual fund buys and sells its holdings. High turnover can lead to higher trading costs and increased taxable distributions. Some funds, like index funds, have low turnover, while actively managed funds may trade more frequently. Understanding a fund's turnover rate can help you assess its cost efficiency and tax impact. These can have a significant impact on your investment returns over time. Even small differences in expense ratios can add up, especially with long-term investments. When comparing mutual funds, pay close attention to all costs, including management fees, sales loads, and other expenses. Choosing low-cost funds can help you keep more of your returns and achieve your financial goals faster. Investing in mutual funds is straightforward, but there are common mistakes to avoid. Don't chase past performance or invest without understanding the fund's strategy and risks. Avoid over-diversification and high-fee funds that can erode your returns. Take the time to research, read fund documents, and align your investments with your goals. A thoughtful approach helps you avoid pitfalls and build long-term wealth. Financial advisors can help you select mutual funds that fit your investment objectives, risk tolerance, and time horizon. Advisors provide personalized guidance, help you navigate complex choices, and monitor your portfolio over time. While some investors prefer a do-it-yourself approach, working with an advisor can add value, especially for those with more complex financial situations or limited investment experience. Investment landscape is always evolving, and staying informed is crucial for success. Keep up with market trends, fund updates, and changes in regulations that may affect your investments. Many mutual fund companies provide educational resources, newsletters, and performance reports to help you stay on top of your portfolio. Continuous learning empowers you to make better investment decisions and adapt to changing conditions. Successful investing with mutual funds requires a long-term perspective. Markets will experience ups and downs, but staying focused on your goals and maintaining discipline can help you ride out volatility. Avoid making impulsive decisions based on short-term market movements. Instead, trust your investment plan and give your mutual funds time to grow and compound. As your life circumstances change, such as marriage, having children, or nearing retirement, it's important to review and adjust your investment portfolio. Mutual funds offer the flexibility to reallocate assets as your goals and risk tolerance evolve. Regularly revisiting your investment strategy ensures your portfolio continues to support your financial needs at every stage of life. Mutual fund industry continues to evolve, with new products, technologies, and investment strategies emerging. Innovations like robo-advisors, ESG funds, and lower-cost options are making mutual funds more accessible and tailored to individual needs. Staying informed about these trends can help you take advantage of new opportunities and ensure your investment portfolio remains relevant and effective. Summary: mutual funds play a crucial role in investment portfolios by offering diversification, professional management, and accessibility. They cater to a wide range of investor needs from beginners to experienced professionals and can be tailored to support various financial goals. By understanding how mutual funds work and how to use them effectively, you can build a resilient, growth-oriented portfolio. Remember to stay informed, review your investments regularly, and keep your long-term objectives in focus.